Hi there, this is Joe Strike. I'm one of the financial advisors on our team here at Life Well Lived Financial Group. I am a certified financial planner practitioner and I lead the investment committee. We wanted to share our outlook and prediction for 2026. If we look at the major analysts and what they are saying for the year, there's a big range of anywhere from 4% to 18% in terms of performance of the S&P 500, which is clearly very inconsistent. Candidly, a lot of these are best guesses, and if we look historically, a lot of these firms tend to revise their estimate over the course of the year. For international markets, there does seem to be a general consensus that the pricing of those markets is still relatively attractive. So the consensus guess is that international stock could be set up for another strong year in 2026. On the fixed income side, bonds still have pretty decent yields. We would call them reasonably attractive. They have been higher within the last few years and come down a bit, but compared to several years ago when rates were close to zero, they're still pretty decent. So we do have some bond exposure. Typically, we're going to lean much more into quality bonds. Bonds can have a range of credit quality and risk. The less risk, the less they're going to pay you. And if you're going to take more risk, you want to be adequately compensated for that. Right now, the compensation for those high yield bonds is pretty low relative to the historical range. So we are very limited with our current use of high yield bonds. So what does this mean in terms of what we are actually doing as a group with our portfolios at the beginning of 2026? Right now, on the fixed income side, we're going to stick with our current strategy, which is to lean more into the high quality bond side. We want those bonds to behave somewhat predictably. If the stock market hits turbulence, we would like those bonds to hold up better and do their job. Some of those high yield or junk bonds tend to move much more closely with the stock market versus something like a super high grade corporate bond or a US government bond. On the stock side of things, we are looking at a modest increase for the target amount of international stock versus US stock. And in some cases, that just means holding on to the relative outperformance or growth from last year. Some clients may not see much, if any, of additional purchases. That just means that it has grown faster. We're going to hold on to that bigger slice of the pie. It's about 1/3 of the stock exposure at this point. We do use some stock investments that have a buffer or downside protection. So if the market were to drop a lot in a given quarter, you would have a good amount of protection against that drop. You give up a little bit of potential on the upside, but it tends to be a good trade-off and a good strategy in addition to bonds when we think about risk versus reward versus growth potential. When we put all those things together, that's diversification, and our goal is to have different things in there that will predictably behave differently under different market conditions. That does a couple of things. It smooths out that performance or that graph where you track your performance over time. The expectation is that it's less bouncy. And for those clients who are retired or taking income from their portfolio, it gives us choices of where to take the income from, with the hope being that if one thing is suffering, other things will hold up much better. So we can tend to follow that golden rule of buy low, sell high.